Middle East tensions and war headlines remain the key market drivers, but US efforts of de-escalation are offering some relief to investors despite no material easing of tensions there. Meanwhile, global macroeconomic backdrop is really weakening due to higher energy prices due to the Middle East war, according to yesterday's PMI surveys, many of which showed weakening activity around the world and higher price pressures. And there is no doubt, everyone is hoping for a quick normalization of prices and the situation and dreaming of a relief rally across global equity markets. But with US equities only modestly off their highs, the risk of a deeper correction remains if growth deteriorates further and central banks around the world are forced to stay hawkish. So welcome to Swissquote's Daily Market Talk. It's Wednesday, 25th of March. I'm İpek Özkardeşkaya, and everything I will say here is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So Middle East headlines continue to drive global financial markets, and there is a notable effort from the US and its president to ease tensions there. Donald Trump has actually given a 5-day ceasefire to Iran at the start of this week, remember? He said that he had productive and constructive discussions with an Iranian official. That was denied by Iran, by the way. And yesterday, he said that Iran has offered a present to the US in the Strait of Hormuz. Now, nothing has been confirmed to my knowledge from the Iranian side, and that's a bit disquieting. But what's clear is that Donald Trump needs this war to end and end quickly, but whether he can materialize this wish is yet to be seen. There are news that 3,000 troops are now headed to the region right now. So if US boots hit the ground, the war will likely escalate. Now, I'm obviously not taking Donald Trump's words at their face value, but his unilateral efforts give hope to investors. Oil is lower this morning. Brent is down by more than 3% at the time I'm talking here, while US crude was down when I first sat down, but is now up by around 1.5%, and the prices are moving very fast. Equity indices, on the other hand, in Asia are pushing higher. Nikkei rebounds near 1% after a flat session yesterday, while the Korean Kospi index recovers 1.5% as US and European futures are pointing at a positive start, but this could change and gains seem fragile as US dollar is pushing higher nonetheless this morning. The dollar yen is up for a second straight session, flirting again with the 159 level. What keeps the dollar yen contained near the current levels is the fear. That fear of direct intervention from the Japanese officials to tame the downside pressures in the yen, and latter is quite effective indeed in demoralizing FX positions and taming speculation. But anyway, I was saying sentiment among investors across the globe is cautiously improved, but the fundamentals have taken a hit after almost a month of fighting in the Middle East, with energy infrastructure being bombed and the Strait of Hormuz, which is critical to global trade, remains closed. This is what yesterday's PMI data showed. Australia's composite PMI, for example, slipped into the contraction zone that's below the 50 mark, while Euro area's private sector activity grew at the slowest pace in almost a year, also printing the biggest decline since the Ukrainian invasion a few years ago. The manufacturing activity across Europe, which is a smaller share of the economic activity, came in better than expected, but price pressures rose worryingly. In the UK, for example, manufacturing costs rose by most since Black Wednesday of 1992, according to the PMI survey, the most since 1992. Now, one hope is that this month's price spike could be temporary if the war in Iran stops today and oil prices ease sustainably. In the past, the Gulf region experienced similar shocks, most notably during the Gulf War. That was when Iraq invaded Kuwait in August 1990, and oil prices jumped by then from around $15 per barrel to nearly $40 per barrel level in just 2 months, and that spike rattled markets worldwide. But the good news is that the stress was short-lived by then. By the time the coalition forces intervened and the war ended in February 1991, oil prices had already started to moderate. 1 month later, volatility remained elevated, but 3 to 6 months later, while stabilization began, the energy market had largely returned to pre-war levels, and 1 year later, markets across the globe had largely returned to their pre-war trend. So global markets had absorbed the shock quite fast within a year, with equities and commodities resuming their previous trends. So if history is any guidance, if that's the case with today's crisis, oil prices could eventually stabilize near the $80 to $85 per barrel range for the next months, and the US dollar could ease to offer double benefit to global economies. And in a year from now, we could see oil coming back to $60 to $70 per barrel range. But obviously, there are a lot of ifs in the short one to say what's next in the coming days and weeks. So volatility will likely remain on the menu. What's certain, however, is that investors cannot wait for tensions to ease and wish for a post-liberation day-like rebound in global financial markets. And I would argue that we will see a rebound at the end of the day, but the dip in US markets hasn't been as bad as last year's tariff sell-off. Because last year, the S&P 500 had lost more than 20% before rebounding. Right now, the S&P 500 is just a little bit more than 7% lower compared to its January peak. Therefore, I would not rule out the possibility of a deeper sell-off before the buyers confidently return to the market. And well, the macroeconomic backdrop has deteriorated since a month. Energy prices are higher. Operational costs will be squeezing margins. The Fed and other major central bank expectations turn more hawkish, and markets don't think that the Fed could deliver a justified rate cut this year, and the private credit stress is also building as AI anxiety continues to rattle software companies. In this context, iShares expanded technology software ETF took another hit yesterday. It fell more than 4% indeed on news that Amazon's cloud computing unit is now developing an AI agent to automate some functions for sales, business development, and other groups to cut more jobs. And that's another issue, right? AI automation leads to job losses that the Federal Reserve could be tempted to tame with a relatively softer monetary policy than its major peers, as the Federal Reserve in the US has a dual mandate. It should keep prices stable but also make sure that the jobs market remains healthy, while many major peers like the European Central Banks, for example, have a single mandate: inflation. So released this morning, inflation in the UK came in higher than expected. Headline inflation steadied near the 3% level in February as expected, but core inflation, which matters more for the Bank of England, rose unexpectedly to 3.2%. Both of these numbers are well above the Bank of England's 2% policy target and are set to take a lift in the coming months due to the recent rise in energy prices due to the Middle East war. So the latter expectation and rising inflation expectations have already turned the Bank of England rate expectations upside down. Remember, last week the Bank of England kept its interest rates unchanged, whereas it was supposed to cut the interest rates hadn't the war happened. And now the Bank of England could even raise the interest rates in the coming months if price pressures in the UK due to rising energy costs don't ease immediately. And the latter looks bad, extremely bad for the government's fiscal headroom, as well as rising inflation expectations and a more hawkish Bank of England outlook pushed the 10-year gilt yield above the 5% mark earlier this week. This was the highest level since 2008. And that means that the UK's government may need to tighten its own purse strings if energy crisis deepens, or release fresh measures to help people, both of which is not brilliant news for the financial markets. Because if the government decides to spend less, growth will be impacted negatively. And if it decides to spend on energy by capping energy prices or thinking of energy subsidies, it will need more debt. And both are bearish for sterling, as I said. Cable sees resistance today near its 200-day moving average. That's near 134.30 level, while the 0.86 level in the euro dollar could act as a floor, and that despite a death cross formation on the daily chart where 50-day moving average crossed below the 200-day moving average, which could favor further gains in favor of sterling. But I think that's not going to be the case because both euro and sterling are vulnerable faced with energy crisis, but sterling is more so as the British economy is more sensitive to energy shocks than the European economies, and finances in the UK are also more fragile since Brexit. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.